Today, Coinbase shares pop after the company posts its first quarterly profit in 2 years. We bring you an inside look at the Africa Tech Summit in Nairobi, Kenya. And as several crypto companies begin to emerge from bankruptcy, we explore what it means for the industry, markets, and for customers with tied-up funds. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto prices in the red to end the week. However, Bitcoin still traded above $52,000 as of noon Eastern. The cryptocurrency dipped less than 0.5% compared to the day before. Ether dropped more than 1.5% to the $2,700 level after crossing $2,800 yesterday for the first time since May 2022. And Solana fell more than 4% to $109. For the week, Bitcoin's up more than 9%, while Ether jumped nearly 12%, all as of noon Eastern. All right, let's talk about the top stories. Coinbase shares surging today after the company posted its first quarterly profit in 2 years. The largest U.S. venue for buying and selling crypto revealed yesterday after the bell that net income totaled $273 million in the fourth quarter. The profit was driven by broad expectations that macroeconomic conditions will improve this year and the approval of the first spot Bitcoin ETFs in the U.S. The majority of the 10 currently trading spot Bitcoin ETFs use Coinbase for their Bitcoin custodian.
For anybody worried about cannibalization, ETFs have been positive for the industry, which has been additive for Coinbase. We're seeing elevated engagement and net inflows across both retail and institutional Q1 to date. What's even more important is that every institution is now starting to hold crypto. The asset class will be a standard part of every diversified portfolio.
Coinbase said that its net revenue was $905 million in the fourth quarter, up nearly 50% from the same period last year. It said transaction revenues were the primary driver of revenues for the last quarter of 2023, and added that subscription and services revenue remained relatively flat. The company added that consumer trading revenue was nearly $500 million for the quarter. That's up 79% from the quarter before. In an exclusive interview with CNBC yesterday, Coinbase's chief financial officer said that the company didn't have to adjust fees to account for the higher volumes coming through the platform.
A lot of the results of our fee rate is just the mix shift on our platform. Who traded what product in the quarter? And so in Q4, when we saw higher volatility, we grew simple trading, but advanced grew more. And so the growth of those advanced trading customers and the volume per trader led to the fee rate coming down on average in the quarter. But it's purely mix shift, just math, no change to fees in the fourth quarter.
Coinbase shares soared more than 15% by midday today. Next, crypto companies, investors, and a whole lot more came together to discuss leading technology innovations at the Africa Tech Summit in Nairobi, Kenya. That event wrapped up yesterday, and Crypto World's Mackenzie Sagalos was there to find out why stablecoins are getting so much attention at the summit.
I'm here in Nairobi for the Africa Tech Summit, where I've been speaking with CEOs from across the continent about everything from generative AI integrations into banking to the latest innovations in crypto, DeFi, and fintech across Africa. Visa, AWS, and Stripe are all here, plus some of the biggest local players in cross-border payments. Now, by far, the biggest topic of the conference is the mass adoption of USD-pegged stablecoins in Africa.
So we use stablecoins like Tether, USDT to move money from one place to another, so moving money from the African continent out and even within Africa.
One reason why stablecoins are so disruptive in Africa is the fact that there's virtually no access to dollars across the continent. So if you go to a bank and need to make an international payment, you can't really do that with traditional financial infrastructure, in part because there is very little liquidity of local African currencies. What stablecoins like USDC are doing is giving people access to dollar-denominated currency and yield for the first time ever.
So we use stablecoins really to help people do everyday things like money transfer or sending money across Africa, because at the moment money transfer across Africa is very hard and at the same time very expensive. Using blockchain and crypto technologies allows us to make it cheaper, the rates even better for every customer, and accessibility as well. It comes straight to your app. You don't have to go get it in a bank or anywhere else.
Stablecoins are also considered a safer store of value than local fiat currencies in some countries. And crucially, they provide a way for people to access dollars in order to do things like move money around the world. Another hot topic at the conference is how virtually all the big fintechs are using generative AI and credit scoring to evaluate prospective customers. Meanwhile, Bitcoin's recent and massive jump in price to levels not seen since the last bull run in 2021, not as big a focus for many people on the ground here, because it's really all about getting access to USD in some capacity.
All right, turning to crypto bankruptcies for our main story. 2022 was a year filled with crypto defaults. Now, more than a year later, some of those failed companies are restarting operations and gearing up to repay customers. So what does this mean for those who have yet to see reimbursements and as other bankruptcy proceedings linger? Crypto World spoke with experts to find out.
Between $35 and $45 billion of funds are still tied up in crypto bankruptcies. That's according to a February 15th estimate from Xclaim. Now, some of the companies that went under in the industry's 2022 meltdown are emerging from bankruptcy.
All these different companies tied back to 3AC, and so when 3AC went bust, it really set a clock for the rest of them.
There were 2 tough years. We had Terra Luna collapse, we had FTX, we had Celsius.
So far this year, Celsius exited bankruptcy and began repaying customers. Core Scientific relisted shares on the NASDAQ, and lawyers representing FTX said they expect the exchange to repay creditors in full. Bankruptcy courts are challenged with untangling debt and assets in a relatively new industry. Then they face the difficult decision of whether to prioritize getting money back to creditors or rebuilding the existing business.
Not many of them are really being successful in relaunching operations. FTX, there was a lot of discussions around whether the exchange component, which during its heyday was really regarded as a very good trading platform, whether that technology was valuable and worth restarting, because if it was, then you could give creditors another pathway to their money back.
Bankruptcy's priority is to maximize the recovery and to keep the business intact, maybe in conflict to one another. It may be better to liquidate the company and get people their deposits back than it is to try to use those deposits to rebuild a company that nobody wants to do business with anymore.
So, if you're a customer who has money tied up in these companies exiting bankruptcy, what should you expect?
In the US, the assets of the company are valued at the time of the bankruptcy. If you had 1 Bitcoin at FTX, you're going to think, well, I had 1 Bitcoin. I should be getting $50,000. Really, what you'll get is $18,000. But because the prices of the assets have rallied so much, there's a better opportunity to cover all the customers for which there aren't the crypto deposits there.
First, it's important to remember that not all creditors are treated equally in bankruptcy courts, and that's exacerbated by the unregulated nature of crypto. The difference really comes down to secured versus unsecured creditors. Secured creditors get priority when it comes to repayment because their funds are backed by collateral.
You always have to make sure that the secured creditor gets its value back, because the bankruptcy laws are not allowed to hurt that collateral interest through the bankruptcy process itself.
Unsecured creditors, not so much. They're stuck at the back of the line when it comes to repayment, and many customers, like the ones at Celsius and BlockFi, are classified as unsecured.
And they were told in some of the marketing promises, especially in Celsius's case, that it's almost the same thing as if you deposited your crypto in your savings and loan and local bank. Well, the bankruptcy court ruled, in fact, you made a loan, and now you're left as a general unsecured creditor. That is very, very tough news to hundreds of thousands of customers who thought very differently. And it wasn't just Celsius. So BlockFi, for example, followed the Celsius rules. Add them 2 together, well north of 1 million customers found themselves not thinking that they were going to be unsecured creditors in a bankruptcy case, losing their savings, losing their deposits, and being stuck at the bottom of a priority ladder, fighting for scraps at the bottom of the case. But that's in fact how it ended up.
So when it's all said and done, how long should customers expect to wait before receiving their funds?
This is really a process that's dependent on how fast the courts move and how fast the regulatory agencies that are also involved move. So in the case of Celsius, there was an earlier plan to restart not only a mining operation, but also an operation that would run validators that could earn staking yield on tokens. The SEC got in the way and said, no, we don't want that. And because of that, it took a little bit longer.
Crypto companies are also looking to unique ways to make customers whole. Celsius has restructured into a mining business as a way to repay debt. FTX has looked to sell major crypto holdings to reach 100% repayment. Those asset sales have had an effect on the crypto market. Prolonged pressure on the Grayscale Bitcoin Trust as FTX sold its holdings weighed on Bitcoin's price for several days in January. Genesis has also been given the green light to offload over $1.3 billion of the product.
FTX, which held massive amounts of Grayscale Bitcoin Trust product, now selling that product because they have much more liquidity to do so, via the new Bitcoin ETF.
And no matter what, the crypto industry still has to deal with the issue of public trust, which has been damaged by the slew of failed businesses.
The crypto industry has gone through 4-year cycles of what we call crypto winters and crypto summers. And as a company, you need to be able to weather that out.
It's kind of hard when you've lost trust and you've lost so much money into a system for anybody wanting to provide capital or otherwise provide trust. I root that all into the lack of regulation because people's expectations were dashed so significantly that it makes it very, very hard to feel like, why, once bitten, twice shy, why would I support it again?
All right, that's all for Crypto World this week. We'll be back again on Tuesday after the President's Day holiday, and we'll see you then.